Options may be traded in the OTC markets using customized contracts, or they may be traded on an exchange using standardized contracts. The contract can be physically settled or cash settled. Usually, exchange-traded options are cash settled. The exercising of the options depends on the style of the option. American options can be exercised anytime during the tenure or even on the expiry date. European options can be exercised only on the expiry date. Till now, we have learned about the call option, which is a right to buy the underlying asset. Now, let us learn about the put option, which is the right to sell the underlying asset. Miss Kim has an equity share currently valued at $800. She is planning to sell it after a month, but she is worried that the share price may fall. She enters into a European option contract with her stockbroker to sell the share for $800 at the end of the month. She pays a premium of $20 to the broker. This option contract is a right to sell the underlying and is known as a put option. As Miss Kim is buying this option from the broker to sell her shares, she is the long put. As the broker is selling the option, he is the short put. Long put is the person who buys the option to sell the underlying. Short put is the person who sells the option and promises to buy the underlying if the option is exercised. If the share price at the end of the month falls to $600, Kim will exercise the put option and will sell the share to her broker for $800. Alternatively, if the share price increases to $900, Kim will prefer to sell her share in the stock market for $900 instead of selling it to her broker for $800. If she decides to exercise the option and sell the shares to her broker, the broker has to buy the shares. Thus, she has a choice, but the broker has an obligation. Let us understand the payoffs under various scenarios for both the long put and the short put. If the spot market price is less than the strike price of the put option, the option will be exercised. Example, if the stock exchange price is only $600, Kim will exercise the put option and sell her shares for $800 to the broker. Her profit is 800 minus 600 minus 20, the premium paid, which is equal to $180. The stockbroker will face a loss of $180 in this scenario. As the option is profitable and is exercised, it is an in-the-money put option. If the stock exchange price is $900, Kim will not exercise the put option and will prefer to sell the shares in the exchange. She will lose the $20 premium paid, and the stockbroker will gain the $20. As the option is not exercised, it is an out-of-the-money put option. If the actual stock price crashes to $400, Kim can still sell the shares for $800 under the contract. Her gain in this scenario is 800 minus 400 minus 200, which is equal to $380. The stockbroker will face a severe loss of $380 in this case. The option is ITM. If the stock price increases to $1,200, Kim will not exercise the option and will prefer to sell the shares in the exchange. She will lose $20 and the broker will gain the same. The option is OTM. If the stock price remains at $800, Kim will still lose the $20 premium paid. The option in this case is at the money. If the stock price falls to $780, Kim will exercise the put option. But in this case, 800 minus 780 minus 20 is equal to 0. And this is the break-even price. At this price, neither parties make any profit or loss. The option is ITM. The payoff diagram for the long put and the short put can be graphically represented as follows. The spot price of 780 is the break-even price, beyond which the long put starts making profits and the short put starts incurring losses. The long put can earn unlimited profits, but his losses are limited to $20, that is, the premium paid. For the short put, the maximum profit he can earn is $20, that is, the premium received, but his losses can be unlimited. Here is what we can conclude. When the spot price is less than the strike price, the put option is exercised and it is an in-the-money put option. When the spot price is greater than the strike price, the put option is not exercised and it is out of the money. For a long put, the profit potential is unlimited and the loss is limited to the amount of premium paid. For a short put, the profit potential is limited to the amount of premium received and the loss potential is unlimited. The break-even price can be calculated as the strike price X minus the premium P.